Good morning and welcome to the Morning Spotlight Podcast. I'm your host, Mike Ham, coming to you as always from the Spotlight Studios here in Morristown, New Jersey. My guest today is the co-founder of JWE Real Estate Capital, which sells rental properties in Jacksonville, Florida. These properties generate passive income streams while providing their clients with peace of mind. He is Gregg Cohen. Gregg, welcome to the show.
Thanks so much for having me, Mike.
It's great to have you on. So you are a real estate guy. I think you have a podcast as well, too, right? What's the name of the podcast? I should have asked that before we even got started, but the name of the podcast is
the Not Your Average Investor Show.
Not Your Average Investor Show. Love that. So we're going to talk about that at some point over the course of this episode. But talk to me about maybe how you got into real estate. Have you always been in real estate, or is this something like a new venture for you? I'll put new in quotes if it's been a while.
Well, I'll take you through the timeline. I've been around the block for 16 years now. Our business has been around here, so I wouldn't say I'm new. But if you had asked me 20 years ago if I would be investing in real estate, the answer would have been hell no. I didn't come from a background of real estate. My family doesn't invest in real estate or didn't invest in real estate until I jumped in the game, and certainly didn't come from a place where real estate investing was the thing to do. But I started working in corporate America, and I just tried really hard to get a great corporate job in college, and succeeded and had a job that my mom was really proud about. My dad was really proud about. I was really proud about for a while. Yeah. And while I was there, I was there for the better part of 2 years. I just really felt that it wasn't the right thing for me. Right. And, I was very blessed that there were others that were going through that situation at my job as well. And a friend of mine turned me on to this wonderful book called Rich Dad, Poor Dad. And that book changed my life. I remember I literally read that book one night, read it, started reading at like 9 o'clock at night, put it down at like 2 o'clock in the morning, and told myself I was going to quit my job and start my own real estate investment company. Okay. Which is totally not like me, if you know me. So from that point forward, grabbed one of my best buddies who was also jobless, or he was jobless at that time and really didn't know what he was doing, but we've been best friends for quite a while. And we set out to do real estate in a different way. People had always sort of looked at it as a hobby whenever we would go to real estate investment conferences. We found that people treated it like a hobby. And we just felt that, the fundamentals of real estate and holding on to it long-term are really undeniable. Yeah. And if we could treat this as a business and help people come up with a way to make real estate investing easy, that we could do some really great things for clients and of course, enjoy a substantial rental property portfolio for ourselves, which we've been able to do over the years. Yeah, for sure. And we're going to get more into the portfolio and what you guys actually do. But so Rich Dad, Poor Dad, just to say it, is easily the most referenced book on this show. Like anybody that's ever come on here, and everybody, but 90% of the people that have come on here that have done something similar to what you did, jump from a corporate job into real estate investing, Rich Dad, Poor Dad is always the book that they reference. But talk to me a little bit about, I'm sure lessons from the book kind of drove you to it, but like why, if you were unhappy or it wasn't really what you wanted to do in that first corporate job, you said you were there for 2 years. I guess that was your first job out of college. Like, why not try something else? Like, why not go to a different corporate job? Well, that's a really good question. For me, I think the negative experience that I had in corporate America, I thought was going to be similar in other corporate jobs. And, I was 23 at that time. And what really made me take a leap and do something that was very uncharacteristic of me and was, risk and reward, or, we all act on basically following some type of opportunity or avoiding pain. And, for me, it was a combination. The pain that I felt as far as what my working life was very, very powerful. Yeah. And I thought that the next corporate job was probably going to be a similar shade of that pain. Right. And then I really, again, based on the fundamentals learned through Rich Dad, Poor Dad, and through some mentors who helped me tremendously early on understanding the fundamentals of real estate, I said, wow, there's a tremendous opportunity here. So if I had to choose between what was bigger, the opportunity or the avoidance of pain, it was definitely the avoidance of pain, which made me leave corporate America. And rental properties obviously was an opportunity for me to work with a best friend of mine. I now have 3 business partners, and we're like brothers, and we've built this company now. We have 80 plus teammates here in our office, and we get the opportunity to do it in a way where we get to truly enjoy the people that we're working with, and the people that we're serving. And, I learned a lot of great things in corporate America, but I certainly didn't feel like I was fired up to work with the people that I was.
Yeah, for sure. And everybody gets that to a certain degree. This may be an impossible question to answer, but I'm going to ask it anyway. You said you were 23 when you made this jump from what you were doing to basically what you're doing now. Do you think that would have been different if Rich Dad Poor Dad didn't get into your hands maybe in like 5 years later, 10 years later? Or was this something that like the wheels were in motion, so you were going to figure it out whether or not you read that book, you were going to figure something else out, whatever that may be?
Man, I really love this question. I've done a lot of podcasts and had opportunities to speak, and nobody's ever asked me that question.
That's like the best thing. You're a podcaster, so people that say that's like the best thing that any podcaster can hear. So like, if you've never been asked this question, that means I'm doing my job. So I love that. Yeah,
man. I mean, it's just really, really fun and refreshing to just kind of rethink about that time and give you some off the cuff answers. I think that was at a moment in my life where I knew I needed to change, and there were so many positive things in my life happening at that moment, pushing me towards a change, that I think I would have made one. One of the biggest things that was pushing me towards a change was my best friend and my business partner, one of my business partners now. And, he is a serial entrepreneur, and he'd been my best friend since high school. And we lived together in college and then post-college here. So he was a great motivating factor. I know I would have been doing something different. I can tell you his strategy for helping me take that leap, which he was already convinced he was going to do. He was going to start his own company. Yeah. And he wanted me to jump with him. His strategy was he moved in with me. He lived in Gainesville at the time. I lived in Jacksonville at the time, and he moved into my condo. He didn't have a bed, didn't have a bedroom. He just slept on the floor. And he was like, I'm going to make sure you see me every single day looking for properties, building this real estate business. And when you come home, you're going to see me drinking a beer after I've just been scouting properties, doing what I like to do. Right. And you're not going to be able to deal with this for very long. Yeah. And you know what? He's a genius in his own right. I wasn't able to deal with it very long. He knew that I wanted to do something different and wanted to do something with him. And so that factor would have been there even if Rich Dad Poor Dad wasn't there. But I'm so glad that Rich Dad Poor Dad helped form my next venture. Yeah. So let's talk about what you actually do now. So like what JWB, I almost said JWB does, the types of properties that they're investing in. I think we alluded to it in the bio that I read at the beginning, but just kind of take us through like the 30,000 foot view of what you guys do, what you invest in, and how you make that work. Yeah. So JWB is a vertically integrated real estate investment company. And so the mission that we have is to take this thing that is called real estate investing and make it easy for people, for the masses, for everyday people to be owning rental properties and enjoying the 5 profit centers that come from owning rental properties long term. In the past, people have long seen that there was an opportunity to earn a great rate of return in real estate. In fact, if you ask most people on the street if they thought that real estate investing was a great long-term investment, most people would say yes. But when you ask those same people, do you own any investment properties? Usually the answer is no. Right. And the reason for that is because it's hard. There are obstacles there. You have to have different teammates. You have to find a real estate agent. You have to find a contract. You have to find a property manager, a lender, a title company, you name it. There's a lot of pieces that there we go, right? You have to find great people if you need all along the way. Let me know. Yeah. There we go. And when you have to align all of those folks, you have to get them then speaking the same language. And there's so many times when your real estate agent you buy with might not have the same rent calculation as the property manager at the end of the day, and who gets stuck holding the bag is the investor. And so it's a hard process, or it was a hard process. And that's what our aim is to change. We believe that investing in rental properties is a wonderful asset class, and good times and in bad times, it's something that produces consistent income. And then of course has upside and tax savings and access to great rates on financing and great hedge against inflation. So it's this wonderful asset class that people can really take advantage of. And it's been a shame that more people haven't been able to do that, or they've been scared to do that. And so our whole plan has been to bring this whole thing in-house. And so that's what we started to do 16 years ago. So now, Mike, let's say that you were a client. You would probably live in a different state than Florida. Our clients live in 49 states and 13 countries, and they all invest in Jacksonville. They would never call themselves experts in Jacksonville. They would never call themselves real estate investors. They want to work with a team to handle everything for them. And if you were a client, we would work with you. We'd understand what your goals are, what your resources are, what your buying plan is. We'd help you build that. And then we would go to work filling that plan with properties that have been built and tenanted by JWB here in Jacksonville. And of course, we are your long-term property manager as well. So it's all under one roof, all in-house. You have one phone number to call. And of course, everybody's on the same page, moving in the same direction. To get specifics about purchase prices and things of that nature, our typical purchase price is anywhere from about $180,000 to about $280,000, which is great because that's below the national median home sales price, and also the median sales price in Jacksonville as well. So we're below that median, which is important.
Right.
And that means that you're out of pocket, and assuming that you're using financing, somewhere around maybe $50,000 at the low end, maybe up to about $70,000 per property that you'd be purchasing. And like I said, you're not investing in a fund or a syndication or pooling money. At the end of the day, you are buying a property that JWB is selling you. And you, of course, have that long-term management from JWB built in there as well.
Yeah, which I think is really interesting. And I wrote down like 5 or 6 different things. So now I have questions for the rest of the episode. So I mentioned at the beginning that one of the most referenced book on this show is Rich Dad Poor Dad. And generally they're real estate investors like yourself. But at the same time, like the types of real estate investing that these people do are always different. I mean, there's been some syndicators, there's been some, people like you, there's been other people that do different types of real estate investing. Some do like a lot of different types of real estate, like the jack of all trades kind of thing. But what was it about rental properties that drew you to it immediately? Was it like a barrier to entry type thing? Was it something else? Talk to me a little bit about that.
So we had tried all of those things that you're mentioning as well. In the beginning, we were a fledgling business like everybody else, trying to find our footing. And the interesting thing for us, it was 2006 as we were starting our company. And so we tried wholesaling, we tried lease options, we tried seller financing, we tried flipping high-end homes. And, part of what we did was start to build our own rental property portfolio. And so in the first year and a half, we built up about 40 properties in our portfolio.
Okay.
And the thing that I love the most about rental properties is that I really felt like every time I was buying a new rental property, I was buying a little bit of my time.
Okay.
I was creating time ownership for myself. And I didn't really care if it was $100 a month of positive cash flow or $200 a month or $50 a month. What I knew is that this was an asset that was paying for itself. And if I gave it long enough, right, if I held on for a full market cycle, there would be a time when I would truly own my time. And so I looked at every single one of these purchases of rental properties as me buying time for myself sometime in the future. And that's what's always really attracted me to rental properties. The other thing that really attracted me to it is that I've been investing since 2006, started to acquire those properties in 2006 and 2007, as I was mentioning, owned 40 rental properties as a 23, 24-year-old.
Yeah.
Was in a tremendous amount of debt. And it was good debt, right? Sure. It was on rental properties that was paying for itself, but was in a tremendous amount, had a tremendous amount of debt, had never been through a market shift before. And then we know what happened in 2007 to 2011.
Yeah.
The market crashed, and I owned a lot of rental properties at that time. And I think a lot of people in that position would have been really, really scared. And I was scared, right? It was the first time I was going through it. But I gained so much confidence in this asset class because while the world was falling around, and even my other investments outside of rental properties were really taking a beating.
Yeah.
Right. Those were some hard times, hard losses in other places.
Yeah.
My business partners and I looked at our rental property portfolio, and it just kept chugging along. It kept earning $100 a month in each property, right? It wasn't life-changing, but it wasn't something that I needed to sell today. I had no plans of selling it at that point anyways. And it was continuing to work even in a place where the Great Recession was happening and everything else was falling around it. And I gained great confidence in this asset class as being a risk mitigator for me. And, I continue to own those rental properties today, own over 300 here in Jacksonville. And really at the core of it, we get to do that same process that we created for ourselves and do that for others, right? Yeah. Make this easy for others to invest. And, now we serve over 1,300 clients who
Yeah.
purchased over 2,500 properties here in Jacksonville and
Wow.
really try to create that same experience for them.
Yeah, for sure. I love that. And the other question that I had, kind of like tying into that as well, is why Jacksonville? I know that you were living there, so maybe that makes it a little bit easier. But one of the other things that I've noticed about different people that I've had on the show is not everybody invests in their own backyard. Some do, but I would say the majority of the people that we've had on here don't. Like, they invest in different parts. They may live in, as an example, like Idaho, and they invest in Alabama, which, whatever. And they may never even see some of these properties. But what was the attraction to Jacksonville? And have you tried to expand beyond the city, I guess?
Great questions. I would like to say that I scoured the country and ran a technical analysis on every market, and that's why I originally landed in Jacksonville. That would be a bold-faced lie,
yeah.
Right? I happened through the good graces to be in Jacksonville for my corporate job, and then as we started our real estate investment company, just happened to be here. But I do believe Jacksonville is the best place for building passive income in rental properties in the entire country. And there's some data to back that up. So what I would share with all of your listeners is, if you're trying to decide on what market is right for owning single family rental properties over the long haul, there's really three metrics that you need to look at. Number one, you need to look at pricing, right? We need to be able to invest in markets where there's low enough pricing that you can earn a positive cash flow. And so easiest thing to do is to go and look at the national median home sales price, and then look at what your median home sales price is in your market, right? The national median home sales price is right around 400,000, according to the Fed, the Federal Economic Research Development, Bank of St. Louis. You can Google that. You'll see that. And then, in Jacksonville specifically, our median home sales price is a little bit over 300,000. So the first thing that you're looking for there is below median sales pricing compared to the national median. And you can do that for your local market, right? It's free. Everything I just talked about there is free. If you don't have access to your local MLS or multiple listing service, I'm sure you got a friend. I'm sure you got a real estate friend who can get that. The next thing to do is you need to find gross rents that are high. Because if you have low prices and high rents, then you're creating this cash flow opportunity, which is so important. And again, you can get this information for free. It's on the U.S. Census. And so you go and you look up the median gross rents across the country, and you look up the median gross rents for your MSA or your area there, and you want it to be higher. And of course, Jacksonville is higher.
Right.
So that's, again, why we love that. If you take all the markets in the country and you just do those two bits of information, you're going to whittle it down to maybe 10, maybe 15 markets, major markets, right? Markets where you maybe have over 1 million people living. And so you're going to take all of this potential place that you can invest in and really get a short list there of maybe 10, 15 markets. The last step is one that almost no investors take, but I think it's really critical. It's really getting an understanding of how much growth potential you have in your market. People tend to think that this thing called appreciation is something that you don't have any idea what's going to happen. And that's just not the case. Population growth is demand. And, when you look at housing supply and demand drive pricing, and market cycles tend to repeat themselves. And what that means is if you know home price appreciation rates in your market in past real estate cycles, well, you have a pretty good indication of what's going to happen over the next cycle.
Right.
So you can actually go and look and see what your home price appreciation rate is in your market over the last 30, maybe even 40 years. And if you do that, you can compare that to the other short list of markets that maybe you were thinking about. And what you'll find is you'll find big differences. You'll find some markets appreciate at like 2.5% per year on average. Some markets appreciate at 3%, 3.5%. Jacksonville happens to appreciate at a rate of over 4% per year, which is, again, above the median average, against the average of the entire country there. So there's your 3 points. Look for low prices, right? Look for high rents, and look for above average growth based on appreciation rates over the last 30 or 40 years.
Yeah.
And if you can find a market that has all three of those in the positive direction, then that's a really strong market to invest in. That's why I believe Jacksonville's the best.
Yeah, no, that's awesome. I love that. And so it seems like you know what you're doing. And so just talking about that, obviously you do, but like when you were starting out and trying to figure this stuff out, and obviously, you read the book, and I don't think that Kiyosaki like dives really deep into what you were just talking about, because I've also read the book. But was this something that you guys were just figuring out on your own and just being like, hey, like let's do rental properties and then we're going to figure it out, and then 20 years later now we got it, or was this something where you had like people that you were leaning on, like maybe mentors or other people that were doing similar stuff maybe in Jacksonville or beyond Jacksonville that you kind of like learned from and kind of put that stuff together?
Yes, we were very, very blessed to have great mentors early on, right? I mean, we worked really hard to build relationships, but I also just think we were blessed and lucky to have certain people in our lives that helped us, that showed us the fundamentals of how this can work. And that was really critical. We in the beginning, we didn't have any money, so we did all the free stuff that we possibly could do. We went to every real estate networking group, tried to take everybody out to lunch, read every real estate book we could, and built up enough confidence that we actually started to invest in our education and spend $5,000, $10,000 on workshops and training programs. And we spent money to go and travel across the country to go to see other real estate offices to see how they worked and how did they hire employees and all of that stuff. So we spent a tremendous amount of time, money, resources, even before we ever sold our first house, which is the scariest thing to do, is to spend money. There's, a million naysayers out there saying you're crazy to go and spend money. But for us, it was something that we were really, we believed in the long term. We believed in the long term of us as business partners, that we were going to figure this thing out. We were young. We were 23. What did we have to lose? We didn't have a wife and kids at that time. Yeah. And so it wasn't nearly as scary for us as other people. And then after that, that beginning, we continued to invest in ourselves, but we got really good at failing forward. We just got really, really good at trying things. And when it didn't work, we just didn't we didn't beat ourselves up. Yeah. And we just, so we learned a lot through the School of Hard Knocks, tried a lot of different things. And, now we have the benefit of 16 years. Sure. And a staff of over 80, and that combined knowledge is why, I get to sit here with you and, put it all together in a succinct package, right. But I think the biggest thing that anybody can take away is that, there is so much knowledge to be gained by working with a partner who has experience, who's that boots on the ground in your local market, right? Whether that is somebody just as a mentor or somebody as a client, you're a client of that person, right? I mean, there is so much to be gained that will speed up and hopefully improve your overall financial situation. And I'm so glad that we made that investment early on, and I hope others do the same. Yeah.
Yeah, definitely. And so, you mentioned a couple of times, like you have a team of 80, you mentioned your business partner when you first started out was basically like the reason why he kind of gave you like the push into what you guys are doing now. But talk to me about the importance of not only that team, but also finding people, like you mentioned, real estate agents and title people and mortgage lenders, whatever else you're using. So talk to me about like the importance of those two teams and making sure that everybody's vibing.
Man, that is such an under-discussed topic, and it's so critical. Mike, I know you're incredible for what you do and for your clients, and it's because you understand their pain points. You understand what they're trying to accomplish beyond just, the title work that we're doing there, right? We feel like, for our clients, the vast majority will never actually even come to Jacksonville. We'll never actually see the property. We'll never actually even come to a closing table. So the standard for us as far as performing for clients needs to be this wow client service experience. And when you have a complicated thing like a property that probably was just brand new and built, that wasn't there a year before, right? Everything is brand new in that house. And then you have other complications. You have a family that is renting that home that's probably going to live there for 4 or 5 years. Yeah. And the owner doesn't know that family member, right? Like that, if you could think about ways to create complications, I mean, what I just described there is probably
that could do it for sure.
Yeah, exactly. Right. So it's this complicated process. And what we're trying to do is, again, to make this something that's enjoyable. It's something that is easy. We can't do that unless we have incredibly strong partners beyond just, the typical partners you may think of, right? Yeah. I'm talking about our vendor base, right? The contractors who build our homes or who renovate our homes are the same contractors that are ultimately going to be doing the property management replacements of whatever might need to be done as well. And making sure that they are wonderful teammates, timely, responsive, low cost, right? This is the real tail of the decision for our clients, because that's what's going to affect your return on investment for the next 10 years,
right?
20 years. Our title companies that we get to work with are truly such an asset. Our insurance companies are truly such an asset. Like, for example, they get to see the properties even before our clients do. They get to do their research on how much insurance premiums is this one going to require. So that way, when we actually share that potential opportunity for a client to purchase, it is exactly what we expect as far as the cash flow, because it's already been vetted by our different partners all along the way. Financing is another really important partner. So It is so critical to have that team be so strong, and really a secret to our success, as I'm sure it is for you too.
Oh yeah, for sure. I mean, if you don't have a good team, then what are you? You can't do anything. I mean, you could sit here and you could talk all this stuff, and then like somebody actually works with you and like, wow, they actually suck. But if you have like a good team behind you, I mean, that's like title insurance, especially here in New Jersey, New York, a lot of the states up here are the same. It's all relationships and service, because it's all regulated. You're going to pay the same price for the same product essentially. So like if you have good relationships and good service, you're going to do fine. If one of those sucks, you're not going to do so fine. So that's 100% true. Like I totally agree with that. But talk to me also. So one of the things that I'm always interested in, and I mentioned to you before we started, like the demographics really of what our show is, 25, 35, in that age bracket, maybe trying to get into real estate investing. And, like one of the things I always like asking people that come on, I think sometimes people, like you said before, people know that real estate investing is good, but at the same time, there seems to be like this giant barrier to entry, because I mean, we've had people on the show that said, okay, like if you want to invest with us, you got to bring 50 grand to the table. And, I mean, if you're 24, 25 years old and you have that, God bless. But at the same time, like not everyone does, but so then it becomes this cycle where they're just like, well, I don't have that, so I can't get involved. So talk to me maybe like maybe the thought processes. And I know you mentioned some of the stuff that you had done early on, investing in yourself and your education, all that kind of stuff, and reaching out to people and doing as much free stuff as you can. Maybe those are the answers, and I just gave them to you. But talk to me about that. Like people get scared off from real estate investing because they don't have that capital just sitting in their bank account. So like talk to me a little bit through that.
Yeah. Well, people often say that the hardest part is finding the deal or finding the money, right? That's the hardest part of putting one of these properties together. In whatever type of real estate you're getting into, they say that it's hard to find it. It's hard to find it, the money there. And, and I really don't believe that. And I say that because, I was 23 when I started. I didn't come from money. I certainly didn't have $50,000 in my bank account. But my business partners and I, we bought about 40 rental properties in the span of a year and a half. How did we do that? We didn't have that money in our bank account. We became really masters at understanding the fundamentals of this asset class, and then understanding how financing can work to where everybody can win. That lender who is lending the money to us can win. We can win because we're able to build this asset into our portfolio. And of course, the resident was going to win as well, because they were going to have a great renting experience. So I really think that you have to educate yourself in the beginning. You can do that in a lot of free ways. I certainly believe when the time is right to spend some money on some proper education, it's definitely worth it for you. Yeah. But you're going to get to a point where you're going to say, all right, well, I really want to own rental properties, but I don't have 50 grand in my bank account. What do I do? There's a couple of things that I think may be potential for some out there. Many folks aren't aware that you can actually invest using retirement accounts. It's something that can be done. Many people are not aware of it. You might even be able to take a loan against a retirement account and use that money as a down payment for your rental property. So that might be one avenue. But the bigger opportunity, I think, if you don't have the money in your bank account, especially when you're young, like I was, is start to talk to others who might partner with you or who might lend to you, right? Look for other people that are in your corner that believe in your future success, understand that right now the down payment might be the problem for you, and take it upon yourself to create a win-win situation for that person, right? I was really blessed in the beginning. I started to include my dad in this journey. In the beginning, I said, Dad, I'm going to quit my job. I'm going to start this real estate investment company. I want to go ahead and buy this first property. And I went to him and I said, can I have a loan? And it wasn't a gift. He said, yeah, you can have a loan, but guess what? You're going to pay me interest. And I said, well, that sounds fair.
Right.
And so we worked out an interest rate and a payment schedule, and I was able to use that down payment to buy the property. And then because I had worked out the numbers where the rental income was going to, cover the mortgage that I received, plus the additional payment I needed to make to my dad, I was able to create a win-win situation. And we got really good at doing that over and over and over again in different ways and forms. And that's how, a couple of 23-year-old kids were able to buy 40 rental properties in the span of a year and a half.
Right.
While that might not be the exact path that works for you, something along those lines is possible if you really want to build a rental property portfolio. And for those who are 25 to 35, if you can learn and master and start to acquire your properties right now, I believe this is the best time to be buying rental properties, specifically because your interest rates on the loan that you borrow, the interest rates are not going to get any lower. The terms are so advantageous. You can lock in an interest rate of maybe 4%.
Yeah.
And that's going to be fixed for the next 30 years. And time is on your side if you can do this early. So really, I would just change the mindset and start to think about how you can put a win-win together, knowing that down payment is an obstacle for you now, but there's a lot of other resources with people who have that down payment money for you if you can just create a structure that also works for them.
Yeah, no, I love that answer. And I think it definitely is something where I think people use that as like an excuse to just like not do it. It's like, well, I'll never be a real estate investor because I don't have 50 grand, like I was mentioning in my question, but just like laying it out like you did. I mean, there's ways to go about making it work. And one of the things that I thought that was interesting in that answer, kind of going back to an earlier answer that you were talking about and kind of how you got started in real estate, was like you had that corporate job that mom and dad were very proud of. Right. And then you go to your dad and you're just like, hey, I need a loan and I'm quitting my job. I mean, like, was like, what kind of conversation was that? Was he like all for it? Was he just like, what's going on? Because, I mean, like I'm 31, and like my parents come from a different generation. I'm sure you're the same way. So like, talk to me about like that conversation and what that was like. Cause I think that people just get like locked in, like, well, mom and dad want me to do this so I'm just going to keep, beating my head against the wall and doing this 9-to-5 thing.
Yeah. And I felt that it was not easy to have those conversations early on. It was very scary for me. There was even guilt. I felt like my parents had done so much for me to go to college to like get this job that I got, and that I felt like I was letting them down, even though they didn't say it. I felt it.
Yeah.
And I felt like I was letting everybody else down. I mean, when I remember actually when I was eventually leaving that job, I remember walking out, and there was this hallway. There were offices of people that were, managers of my manager and my manager's manager, and all these people that had a higher ranking than me in the company. I remember walking out and them openly mocking me, saying, "Oh, look at Gregg. He's going to go and try and be the next Donald Trump. Look at this guy," and that really, really affected me. I mean, I was 23 years old, right? That was the only corporate experience I had, right? You internalize those things.
Yeah.
So, for me, it was not an easy conversation. But like, I just knew inside of me that I wasn't happy where I was. I just kept going I said, everything comes down to risk reward for me. I said, all right, what happens if I go and chase this crazy dream and everybody else is right? And, and then I fall flat on my face. There's just going to be another job there waiting for me. I'm employable. Right.
Corporate America is not going anywhere, bro.
It wasn't going anywhere. I was like, what if I screwed up and I lost 2 years of gaining what I would have in corporate America? Does that really matter?
Yeah.
30 years later, I was like, no. But, I had something deep inside of me that knew that I needed to change. And, the more I just shared my personal story with my parents about how bad it was at work and how I was dying inside, and now, I would wake up every single day and wish that the next 9 hours of my life would just be done.
Yeah.
They of course supported me soon after. And, I involved them in this journey as early as possible. Not just from a lending perspective, but just from Hey, listen, I think this is what I want to do with my career going forward. And, I'm really serious about this. And this is not just me watching a late night infomercial, and let me show you how I'm doing, and the struggles and the successes. And so, they've been, of course, my biggest supporters. Soon after I broke them to them, not immediately.
Yeah. Well, he needed you to succeed because he wanted to get his money back, obviously, with interest.
That's how I got him in, for sure.
Yeah, right. And then one of the things that you've been mentioning quite a bit over the course of this episode so far is education. So this has been highly educational because it's a podcast, and podcasts are great. So talk to me a little bit about your podcast and how you use that maybe to educate people and kind of explain and have guests on and whatever you do. So talk to me a little bit about Not Your Average Investor Show.
Mike, thanks so much for shedding a little light there. It's become this amazing passion of mine, is doing the show, the Not Your Average Investor Show. And we started a little bit over 2 years ago, pre-COVID. And I didn't really know what we were getting into. But as COVID happened in March 2020, it became so clear to me the value of having a platform, be able to share thoughts, ideas with clients, and with other like-minded investors out there, right? In times when people are really scared, simply being there with clients has been so critical.
Right.
And that was really, really, really important, when COVID broke. And now, of course, we've navigated that process, and the show has become something that is just really fun and engaging. It's called the Not Your Average Investor Show because we are not specifically just talking about rental properties. We're talking about all financial investing and asset classes. And our goal here is to learn more, to educate ourselves so that we are not just following the typical stocks, bonds, mutual funds type of investments. There's an entire world out there of other asset classes, even beyond rental properties, that are wonderful and can help you accomplish your financial goals. And so on the show, we get to bring on other high-level leaders, other investors and other asset classes. Of course, we talk about rental properties when it's appropriate, and I get to, share people in on why rental properties is such a strong investment asset class. But more than anything, it's really kind of a foundational comparing, understanding, what assets are right for a certain type of investor and which ones aren't. And we just have some of the most fun and inspirational guests. So would invite everybody to be a part of it. If it's something that sounds interesting to you, we go live every Tuesday and Thursday at 12:30 Eastern. So if you want to join the audience and actually ask questions to us, there's a few dozen of investors that show up every single week in our show. And it's just a really fun time. And then, of course, if you want to catch it at a time that's more convenient for you, you can just look it up wherever you get your podcasts under Not Your Average Investor Show and tune in.
Yeah, I love that. I love the live thing. I think that's something that I need to do more of because I feel like, engaging. I mean, I have a pretty engaged audience on different platforms, but I think that doing something like that and getting them involved with the show is always great because people have questions and people, may listen to a whole episode and be like, oh, Gregg didn't answer my question. But if you did it live, then there you go. You can ask the question and get yourselves involved and learn some stuff because odds are, I'm asking questions and I think I ask decent questions, but maybe I missed one. Maybe someone was like, oh, Mike, you should have asked this at this point, whatever. But no, but that's great. I love everybody that does podcasts in the real estate world. I just love them. I think they're great. And I just think it's so much fun talking to somebody that's doing something similar, and trying to get the message out there and engage with that community and trying to educate people, which I think is what we were just talking about. Yeah.
And us coming together and me getting to be on your platform here is a direct result of the show. I mean, you tend to just kind of get attracted and get connected with other like-minded individuals, which is something I never really expected when we started to do the show 2 years ago. So yeah, just simply being here today is it's an incredible opportunity that comes from it.
Yeah. Hey, have you seen as the business itself, do you think the podcast has impacted that directly?
100%.
Yeah.
It's the single best marketing thing we have ever thought of at JWB. And it's really awesome. That's the thing that I love to do the most too.
Yeah. So, yeah. Love that. And I, like I said, I feel exactly the same. I mean, life changed when I started doing this show. But last question before we get into our closing segment. So talk to me a little bit about, do you have goals, like things you're trying to accomplish, more units, more rental properties, more investors? Take me through maybe some of the stuff you're trying to accomplish. We can even do like short term, like maybe just like within the next year. I don't know if that's short or not, but take it away.
Yeah. And actually we just did a show revealing JWB's business plan, which we do every single year. So, depending on which part of the company you wanted to ask me about, I have a number. I probably could think of it right off the top of my head as far as how we're growing here. I'll give you a couple of numbers that are, I think, really important. For our team, we have a number of departments now, 80 plus people, as I was mentioning. And one of the coolest things and one of the biggest challenges is making sure that everybody's goal here in this department meshes with this goal here to produce the outcome that we want for clients.
Right.
Last year we purchased 992 properties here in Jacksonville. That was a world record for us by a large margin. We typically purchase about 600 to maybe 700 was our most ever. And so you can say, well, geez, if you thought you were our goal was like around 650 last year. Well, why did we basically, increase that goal or why did we do 350 more property purchases than we expected? Well, that's just because of the opportunity in the real estate space right now. Like I mentioned earlier, I think this is the best time to be acquiring rental properties. And so we have gone as strong as we possibly can to buy as much as we possibly can because there's an urgency behind it.
Yeah.
And so this year, we don't think that the market opportunity is as strong. We don't think there's as many opportunities for us to purchase. So we're expecting to purchase somewhere around 700, 750 properties this year. If we can purchase 1,000, are we going to do it? Absolutely. But it's harder today than it was a year ago.
Yeah.
And then the other thing that's a really big component of our value proposition is that we build new construction homes. So we, last year we built about 250 new construction homes, and for the purposes of these becoming rental properties, for our clients to purchase from us. And this year we're going even bigger. We expect to start and complete 600 new builds this year, which would be a record by double for us, awesome. For sure.
Yeah.
And then of course you've got, your property management numbers are going to continue to go up. Right now we manage a little over 4,300 homes. By the end of this year, we expect to manage somewhere around 4,800 homes. And we'll sell right around 500 rental properties this year. It's really fun. I think that's one of the things that attracts my business partners and I to what we do is the fact that you can never have everything working exactly the way you want it.
Right.
It's impossible.
Yeah.
You see really big gains, right, on the, acquisition side, right? And when you do that and you're like, oh, geez, how do I ramp up construction enough so that we can get those assets into play? And is the building department coinciding with us, right? Are they getting the permits out fast enough, right? And then when you do that, right, how does that affect leasing? Well, now we've got a lot of properties. Let's make sure that we get our leasing to the point where we can rent out 1,500 homes instead of 1,200 from the previous year. So it's this wonderful, dynamic organizational opportunity and challenge that we're always faced with, and we love it. Yeah. That's what we've been doing for the last 16 years. And it's never a dull moment.
No, I would imagine not, but I love that. I love that answer. Love this episode so far, but we are going to move it into our closing segment, excuse me, which we call Under the Spotlight because this is the morning spotlight. So the spotlight has been listening to Mike Hamm and Gregg Cohen talk for a little over 43 minutes. So we've been chugging right along. But if there's one thing that you would want the spotlighters to walk away from this episode with, what would be that one thing?
I want people to understand and start to master smart debt. Not all debt is created equal. Smart debt is the greatest opportunity to create generational wealth, in my opinion. So what is smart debt? Number one, smart debt is debt that is paying for itself every single month with the underlying asset, right? When you take out debt, you have an expense that comes from it. The asset that you've got needs to pay for it every single month.
Right.
And if we're talking about rental properties, because that's my bread and butter. Well, right, you've got rental income that's covering the debt expense as well as the other expenses. So number one, it's got to pay for itself. The debt has to pay for itself. Number two, it has to be inexpensive, right? You can't be taking out debt that has 18% interest and tell me that that's smart debt, right? Smart debt is taking out debt at like 4% rates or maybe even 5% rates, right? And keeping that debt fixed and holding on for 30 years. Of course, I'm referencing loans that are available in rental properties here, but use the same mentality for any other type of smart debt that you're thinking about, right? Number one, it's got to pay for itself. Number two, it has to be inexpensive and have great terms. And number three, smart debt is taken out on things that go up in value over the long haul, right? Rental properties, if you look over time, they go up in value over the long haul. Over a 10 to 20 year cycle is known to be a real estate cycle. And you see property values going up at a very routine pace every market cycle, 10 to 20 years.
Right.
So that's smart debt. If you can do that, and especially right now, especially if you are a 25 to 35-year-old person and beyond that, I don't want to just single that out, but
right.
The quicker you can master smart debt, the sooner you start to acquire smart debt and think of debt as an asset, smart debt as an asset rather than a liability, the more powerful it's going to be for you to create the generational wealth and to really to give yourself the time options that you want 10 years down the road, 20 years down the road. So that's my big ask of everybody is to dive in, understanding smart debt and master it, because I think it's something that's really going to help.
Yeah. Love that. Love that answer. Love Under the Spotlight. Excuse me, just because we always get the bangers during Under the Spotlight. So if people need to learn more about you, need to learn more about JWB, where can they go to do that?
Mike, this has been awesome. Again, thank you to you and to your audience. Anybody who's interested in learning more about JWB can go to our website, which is jwbrealestate.com. You can view available inventory and start to get an understanding of the type of assets that we have and the type of team that we are. So again, you can go to jwbrealestate.com. And if you'd like to join us on the show, you can join us live in the audience by going to nyais.com. That stands for NotYourAverageInvestorShow.com, NYAIS.com. We go live every Tuesday and Thursday at 12:30 Eastern. And again, check us out on the podcast. If that time doesn't work for you, you just find us wherever you find your podcast under Not Your Average Investor Show.
Love it. Love it. All right. So I'll make sure I put both those links in the show notes along with the morningspotlight.com and the morningspotlight@gmail.com, which are the website and email address of the show. So Gregg, thank you so much for coming on with us today. This was a tremendous episode. Shout out to Pablo for introducing us and getting you on here. This was fantastic.
And man, thank you so much for the opportunity. Hope we do it again sometime soon.
Of course, absolutely. And the Spotlighters, thank you for listening, and we will catch you next time.